Hello and welcome to On the Money, a weekly bite-sized show that aims to help you become a more informed investor. This week's episode focuses on the big picture by explaining how the wider macroeconomic backdrop influences how financial markets perform. To discuss this topic, our guest is Michael Browne, who is Chief Investment Officer at Martin Currie. I was unfortunately unable to do the interview, which took place in mid-January, but I've left you in very good hands as I've drafted in my colleague Sam Benstead, our bond specialist at Interact Investor. It's a really interesting interview that covers how interest rates, inflation and fiscal policies influence stock and bond markets. I hope you enjoy it. Over to Sam.
Michael, thanks very much for coming on the On the Money podcast. We're going to talk about both monetary policy and fiscal policy today and how they influence financial markets. So let's start off with monetary policy. Could you first explain how interest rates influence equity markets?
Yeah, thanks very much for having me. It's a great pleasure to be here. Interest rates are really important to every asset class, not just equities. Essentially, what you've got here is you've got that sense that you and I would have at home, which is what does it do to my mortgage? If interest rates go up, my mortgage costs go up. That's less to spend on other things we might prefer to spend it on. So for a business, if their interest costs go up, then clearly they're going to have other costs that they're going to have to squeeze down if they want to keep their profitability the same, or indeed they're just going to have to absorb a lower profitability rate at that particular point in time. That, of course, can then start to impact investment rates. It can start to impact their overall growth rates, their hiring intentions. So suddenly we start to slow the economy down through interest rates, through the business and the corporate system, and indeed through the consumer as well.
And we're in this environment where actually most investors think interest rates will keep falling this year. So we're at 4.75% now in the UK. Markets pricing maybe one or two cuts. The Bank of England said maybe 4 cuts, but time will tell. So in this falling interest rate environment, what type of shares tend to perform best?
So in a falling rate, you'd be looking at two or three sort of kind of key types of shares. First of all, let's go to the most simplistic ones. Those ones with really high dividends. So they're yielding maybe today in the market, you can find plenty of stocks yielding 4, 5, 6%. So if we're going to have base rates fall from 475, let's say, to 375, just make it simple like that. That's your full rate cuts from the Bank of England. Then those shares that are yielding 5 or 6% are going to see some more attraction. You're sure they're going to pay that, right? Yes. Okay. So actually that high yielder, which is going to pay, it becomes more attractive, especially relative to bonds. On the second side, then you've got some sectors which are really positively impacted by falling rates. I talked a little bit about how it impacts the consumer, crimps what the consumer can spend. Well, the reverse is the case on the other way around. And although a lot of us have fixed mortgages today for 2, 3, 5 years, those roll off, we actually get in a position whereby you've got a little bit more money in our back pocket, perhaps, and we might go out and spend it in various consumer leisure ways, etc., like that. So the mortgage gets cheaper, you got more money to spend. Again, on the other side, on the investment side, a little bit pick up, better profitability for corporates, they might invest further. There's one subtle extra as well. Those companies that are high growth companies that might well depend on debt to continue to fuel their growth in the future will have been really deeply derated by the rise in rates, and they will start to re-rate. Their growth becomes more certain. They can begin to accelerate again. They'll find more cash to invest in a period of falling rates.
And how many interest rate cuts are currently in the price of equity markets? It's all well and good talking about these 4 cuts coming, but if the market has already priced that in, then maybe we won't see an actual move. So how many cuts are priced in, and what do you actually think will happen over the coming 12 months in terms of interest rates?
Yeah, everything has changed since the US presidential election. So in the States, the advent of a new party, new takeover by Trump, I'm sure it's Trump Part 2, I suppose, is probably the best way of putting it. People are really worried about increasing fiscal expenditure in the US, and that has raised, alongside tariffs, which are inflationary in the US, raised the picture that actually, you know what, there could be a lot more inflation around in the short term, and prospects for rate cuts in the States. And going on about the US, how does that impact us in the UK? They are the biggest single borrower. They have the ability to set interest rates on a global scale. So what happens in the States really matters to us here in the UK. And as a result, if if it gets more expensive for them to borrow, it will get more expensive for us to borrow, it'll get more expensive for Germany to borrow, and rates will rise with that. So that's why that's been really, really important, that change in government in the States and setting the interest rate agenda very differently. So 30th of November, market was looking for 4 cuts. Today, it's looking for 2-ish. It's more 1 and a bit than it is 2. So the market's really moved a long way. The problem with that is if rates are staying higher for longer, it's going to be less growth.
And what about the bond market then? So could you explain how interest rates affect bond market pricing, including bond yields? So how do interest rates affect bond yields?
Yeah, so let's take a really simple example. So a 2-year bond, which is quite a short-dated bond at 5%, issued for £100. We will buy it for £100. If rates go up to 6.25%, the value of that bond has to fall to 80 because you're selling it in the secondary market and people want 6.25%. On the flip side, if rates were to fall to 4%, then the value of that bond would go up to 125 because your coupon of 5 is actually therefore then yielding just the 4% that the market rates are setting. So market rates versus your bond rate are really important in terms of the way that works to setting the price for gilts, for UK government debt in the secondary market. Of course, if you hold it to the end of its life, it'll still be worth 100. That's what you'll get repaid. So it's really important to bring that into occasion in terms of bond markets, and bond investors hate losses. Above all else, they hate losses. So they really don't like rising rates where they're holding coupons which are lower than the existing bank rate.
We've seen gilt yields rise a lot over the past 6 weeks. So now about 4.8% for the 10-year gilt. How much of that is due to bond markets falling globally, and how much of that is UK specific in terms of people losing confidence in the UK?
Look, I think 40, 50 basis points of that is the global move, but I think there's another 25 to 35 basis points. You can never be wholly accurate with this, but there is a good chunk of that is also very much the UK and what is going on in the UK. We did have a budget which, in the OBR's own words, didn't increase growth in 2 years' time and raised inflation, which puts bond investors, makes them a little bit wary. It's actually, they're going to be asked for more money here. And if the economy is slower over this period of time, then the government will need to raise more tax if they're going to fulfill their spending ambitions without asking the markets to lend them more money. And if they ask the markets to lend them more money, rates will go up again because the market will demand more of a premium. And that's what you've seen in that 25, 35 basis points. The market's beginning to worry about the UK needing more cash to continue to fulfill its political ambitions.
We've seen inflation rise a little bit in the UK. So from 2.3% in October, 2.6% in November. What's your outlook for inflation? And do you think the Bank of England is going to look at the inflation rate and actually resist cutting interest rates, which might help growth, which might help asset prices, because inflation is its biggest priority?
So the inflation picture is really complex here and it's really interesting. So as an investor, this is like, oh, okay, we've got something new. So let's really delve into it a little bit. On the one hand, you've got a number of issues around the wages, service sector, inflation driving numbers at the present moment in time. Oil prices have come back, but they're stabilized at this moment in time. We've got the strange 6-month rollover in terms of how we set prices at the petrol pump, which actually will see a slight increase in the next round of prices. So we've got all these sort of slightly countervailing factors that would suggest that inflation is pretty stable at 2.6. It could touch about 3 and a bit over the year and come back to about 2.6. But on the other hand, as a result of the budget, as a result of rising rates in the market, there is a really significant drop in hiring intentions, in particular in hospitality, in business confidence. We've seen the report that's out today, and other reports that we've seen, which suggests that corporates want to invest less. It suggests that the confidence is beginning to blow away. It suggests that actually the overall growth environment could be quite a lot weaker than we had originally anticipated. Now that's the counter. That's going to mean prices are going to be a little bit lower because the demand is not in the system. So we've got this interplay, and I think that interplay over the next couple of quarters is going to be really interesting to watch.
So if we see prices come down, we see more interest rate cuts than you might expect at the moment, what types of bonds will perform best in that falling interest rate environment?
Yeah, and a lot of that will depend where you are on the curve on where you think the government's reaction to lower income, higher rates, getting squeezed will be. If you think that the government will stick to the fiscal rules and actually will come up with a really tough round of spending in April, then guess what? You want to go longer dated, because clearly the longer dated, which has had the biggest problem in the last 6 or 7 weeks, sold off the most, especially at that 30-year level where you're seeing rates at 540, I think, at the moment, then clearly that will give you an opportunity to buy into those very long rates and see that movement on the capital side. If you think the government will come back to the markets and will borrow more, then actually the only place to be would be in the five and low, as I was actually saying the twos, because what you'll see is the Bank of England won't do one, won't do two. They will do the 4 cuts, not in the market price today. They will get to 375 or lower by the end of this year, and you'll take a little bit of extra premium from that point of view. If you're just buying to hold, then clearly getting 540 on the 30-year, if you think there is some risk that the government will spend and borrow to spend, then that's probably not a bad place just to sit on the interest rate differential.
And final question on bonds. We could hit a 5% yield on the 10-year US Treasury bond or the 10-year gilt. That's a really powerful psychological level and actually could start bringing money out as other asset classes and into fixed income because you're getting that 5% return. Do you think that's correct to say that this psychological level of 5% will be very significant?
Everybody loves a round number. I mean, we all in the markets, we love it when a stock goes through 100 or the S&P goes through 3,000. Or, everybody loves these round numbers. So what I would say to you is that whilst we might be fixated at 5% at the 5-year, and the 5 year is incredibly important for the UK because it's what most people's mortgages are set off. So you put a premium on that for your mortgage rate if you're refixing. Actually, it's not that important in terms of the overall economy. We're already there. We're already sitting there facing the issues of high rates. And if you look at the UK savings map at this moment in time, you can see there's an enormous amount of cash sitting on the sidelines, be it in deposit accounts or be it in short-term accounts. So people are already saying, you know what, inflation's 2.5%, 3%, I'm getting 4.5% from my savings account. Markets still a bit unstable. There's lots of geopolitical risk. Don't know what's going on here or there. Why don't I just sit tight and take 1.5% real for the moment? Absolutely, people are already doing that. So I don't think 5 moves the dial from that point of view for the savers. It will move the dial for the borrowers, but much of that pain is already there.
And now on to fiscal policy. So how does government spending and taxation affect investment markets?
I think I've touched on that a few times already in terms of saying government's an incredibly powerful actor within, in fact, the most powerful actor within any economy, because they have the ability to borrow in a way that you and I don't, almost, I won't say indefinitely, but they can go on depending on what the price is. And what they do with that money, their fiscal policy, is critically important in terms of how we run our lives. And let me give you just a very simple example. NHS, one of the great things that the UK does, free at the point of access, so none of us pay for it directly. We pay through it through our taxation. What would happen if suddenly there was a cap? Let's say there was an income cap to your NHS free at the point of service. Anybody over a certain wage would have to pay for it. Effectively, you might argue they were paying for it twice. Well, you would drive insurance contracts for those people very aggressively that they would have to buy. That drive would then take money away from other things they might spend on, maybe a house, maybe a car, maybe a holiday, and that will contract the economy and move the economy in a different way. So that very simple example, very extreme, I'm not suggesting it's going to happen, that very simple example shows you how the government could impact our spending, our behaviours and our outlooks.
And with what the Labour government has done so far, are there any sectors that stand to benefit or lose out because of new policies introduced?
Well, we had high hopes for the house builders. We had high hopes that freeing up of the amount of land that you could build on, that we would see a renaissance of house building, which had really fallen about 120,000-30,000 units because of high rates. There's an impact of high rates down from about 220, 230 a few years before, that we would start to see house building pick up again. But with this backup in rates, no change in interest rate policy from the Bank of England, but the backup in rates because of the concerns over the fiscal position, we're seeing no great new demand in the housing sector from people wanting to build houses because it's still really expensive to get a mortgage, and it's getting more expensive again at this point in time. So we had high hopes. If we saw a weaker economy, and if we saw rates fall 375 or further from the Bank of England, then that changes the picture again. And here's this really odd thing. In some sectors, you'll see bad news is good news. So you'll see those sectors rally. Now the economy's really weak, and suddenly you see the house builders rally because they're anticipating that further fall in rates, which improves affordability, which will improve demand, and alongside the supply changes will actually change the picture dramatically.
And I guess that just shows how important it is to understand the macroeconomics, interest rate environment, to understand what will happen to equity prices.
Yes, exactly. It is a bit of a crossword puzzle. It's always a crossword puzzle, but things can move around in your crossword puzzle. So you have to be aware of that.
We're sat here in the middle of January. There's a lot ahead of us in this new year. We've got the new president in the United States, new government here in the UK. So what would be your biggest macroeconomic risks that you are talking about at the moment with your investment teams?
Oh, it's undoubtedly inflation. Without any shadow of doubt, how sticky is inflation? What impact will tariffs have on inflation? If there were further restrictions in certain areas, I'm thinking principally the oil markets, because most of our inflation really starts or is driven, the change in rate of the prices is driven out of the energy markets, then clearly all of those factors would have a really negative impact, because central banks are absolutely dedicated to squeezing inflation out over the long term, which is why rates have remained at this very high level for a very long period of time. So inflation would be my number one concern. There are enough elements that could push it and would move it. And that would be the one thing that would make life, I think, difficult this year. Low growth and higher inflation is always the worst outlook, both for bond and equity markets. Doesn't matter where you are.
So that's something you're very worried about, inflation. But what about something you're optimistic about for the next year?
Well, funny enough, I think it's the inverse of exactly that coin, which is the bad news is good news. So if inflation is a little bit higher, if rates do stay higher for longer, if they do compress the economies a little bit more, leading to lower demand, then inflation is going to go away pretty quickly. And we could then end up with a much bigger round of rate cuts. Long term, the neutral rate in the UK is probably 2.5%. That's a long way down from 4.75. And that would be a very optimistic scenario as we sit here now.
So what sectors would you highlight? What companies would you pick out in terms of big winners in that environment?
Long-term growth stocks. And we've got a huge amount of really clever software and technology stocks in the small cap area. Small caps, mid caps over large caps, because again, they're really sensitive to the economy and the consumer coming back, and they would certainly take advantage. And I think on the other side, and I'm sorry to go back to it, our friends, the house builders, would absolutely benefit, and they could easily double their output, which whilst their margins may not grow, is a big jump in profitability.
And in that quite difficult environment, are there any winners?
The banks are always a winner. Yeah. So the banks are taking cash. They're getting a little bit more on that cash from the markets all the time. They're not particularly lending it. If they keep their costs under control and they don't have great loan losses, and we're kind of, that's the way things have been in the last couple of years, the banks have higher margins.
Michael, it's been great hearing your views on the economy and interest rates and everything to do with growth at the moment. So thanks very much for coming in.
Well, thanks to Sam, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and tell a friend about it. And if you get a chance, leave a review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, ii.co.uk. And I'll see you next week.